Living and thriving in our day-to-day society continues to get intriguingly expensive. Therefore, to be comfortable enough to get by, one needs a big enough paycheck. Earning $1,000 monthly is not a bad way to go. But would it be able to afford you the kind of lifestyle you desire? Maybe. The system of making money is such that one needs enough of it to be able to retire early and into luxury. So what do you need to be able to secure the big bag and live a good life while tending to your family, keeping fit, or traveling the world? Passive income. That is why in this video, I will bring you a credible tool that would help you maximize your income streams and to make money without having to put in any subsequent effort. Stick with us to the end as we will be providing bonus tips on how to make this system work faster for you. Don't forget to like this video and subscribe to the channel. Earning $1,000 per month is quite easy with the right information. Making money through passive income is one of the pieces of information you may not have heard of. With this method, you will be able to make money without doing anything. There are different types of passive income structures that will help you make $1,000. Let's get through to some of them. Choosing a dividend yield. Your first step to making $1,000 per month is choosing a dividend yield. This is not supposed to be the highest yield you can get, but it will definitely be the proper amount of growth, income, and stability to suit your situation. You may get confused when you hear people talk about receiving a dividend from a stock that yields 2, 3, or 5%, when you could just purchase a stock yielding 12% and earn much more money. This is where the amount of information you have on the right stocks to buy equals the amount you will make from it. Let us establish the fact that buying something with an incredibly high dividend can be risky. For example, the price could be on a decline, or the dividend could be at risk. This is often the case of an individual stock or even a sector-specific fund. The reasonable dividend yield does not have to be as big as we want it to be. It could start at 0.5% and grow up to a sustainable 5%. That is why it is important to plan on achieving something in that range. The trick is, the higher the yield, the better. Investors are prone to making mistakes like purchasing assets with unreasonably high dividend yields. There are two situations when this could be a problem. The first of which is high yield could indicate a company with slow growth prospects. The second high yield situation is a little more concerning, and that's because the dividend isn't safe. An unsafe dividend means the company might reduce or suspend its dividend in the future due to poor business performance. You must avoid these kinds of companies and do your research thoroughly before you invest. A slash dividend almost always results in a dropping stock price. However, investors might sell the stock beforehand as a slash dividend is anticipated, which will result in a low stock price and a dividend that is still high. For someone who wants a hands-off approach, purchasing dividend ETF like Schwab's SCHD, which is very popular and well-liked among dividend investors, can work nicely. This fund matches the return of the Dow Jones U.S. Dividend 100 indexes. By putting your money into this, you receive a stable 3% yield, with a reasonable amount of growth to ensure the value of your investment rises over time. Another perfect way of making money is investing in VUG. This is Vanguard's growth ETF, and it is perfect for investors who aren't concerned about dividends and just want to receive higher overall returns. This fund tracks the CRSP, Large Capital Growth Index, which grows rapidly on average. This is because the largest holdings are Apple, Microsoft, and Alphabet. These establishments are all large and renowned companies, but the dividends they pay are minimal, with a yield of just 0.44%. You'd need over $2 million to earn $1,000 monthly in dividends. While that seems like a paltry amount of dividends for that much capital, consider that the growth alone outpaces what you'd likely receive in both dividends and growth with the dividend funds. What this means is that even with the dividend fund reinvested, you'd usually be better off with a quality growth fund like this. Perhaps the best mixture of growth and dividends is by purchasing the market or a fund that tracks the S&P 500. By doing this, you receive an average amount of income with an average amount of growth. This is one of the best options for someone who doesn't want to think too much about their investing strategy. and desires a somewhat balanced portfolio. Buying a fund such as VOO or the Vanguard S&P 500 ETF would provide exposure to various companies. You'd own Apple, Microsoft, and Google, in addition to companies like JP Morgan Chase and Johnson & Johnson. The dividend yield is average since you buy the market at 1.31%. To bring in $1,000 monthly, you'd need roughly $920,000 invested. This is still a lot, but significantly less money is needed than a more aggressive growth fund. When you purchase a sector-specific fund, you can receive a high dividend and more diversification than you would from a single stock. A sector-specific fund is dedicated to a certain sector, such as real estate, financials, industrials, utilities, and the like. By looking at different options, you can find some that pay higher dividends than others. If you're bullish in one of those sectors, it could be a buying opportunity. There's usually a reason or many reasons a sector has a high yield, and it is important to understand why the dividends are higher and assess the risk. Vanguard's Energy ETF, VDE, has a high dividend yield of around 3.5%. This is due to the additional risk associated with the sector. You need about $359,000 invested to earn $1,000 monthly on average. However, in early 2020, the energy sector was trading at a huge discount relative to other sectors and presented an opportunity for growth and dividends for those that understand its risks and potential reward. The riskiest and least predictable option is purchasing individual dividend stocks. While you might achieve a higher yield, the stock price's future is less predictable than buying something with more diversification. Knowing the different options with their pros and cons, which direction should you go? A strategy investors commonly use is focusing on growth early on in their investment career. This is the time when your primary concern is achieving higher growth. When you're in your 20s, 30s, and even 40s, dividend income is irrelevant unless you plan on retiring early. Young investors who focus solely on growth will usually have better annual returns than someone who is only concerned about dividend income. Even slightly better annual returns could make a huge difference over time. As you near retirement, paying more attention to dividends can be beneficial if you plan on living on those payments. As you advance in age, you're less concerned with the annual growth and more concerned with the income safety and capital preservation. When approached cautiously, a dividend investment strategy is safer and more stable than a higher-risk growth strategy. The biggest consideration when choosing between growth and dividend investment is how long until you plan on retiring. When you are many years off from drawing on your investments, implementing a dividend investment strategy could cost you a lot of money lost in potential interest. Although it is exciting for young investors to think of dividends as entirely passive income, a rising share price is also passive income, just in another form. It is very easy to make $1,000 a month. All you need to do is choose the right company or fund to invest in. You can also use your growth fund as a retirement plan. So instead of retiring into the arms of pension funds, you will retire into the soft arms of growth funds you invested in when you were young. With the right information, you can earn money through dividend funds, or you can keep it as growth funds and secure cash flow when you retire. Let us know what you think about dividend funds and transforming them to passive income in the comment section below. Leave a big thumbs up on this video if it has been of help. And if you're new to our channel, subscribe and turn on your post notification. See you in the next video.